Hello traders, welcome back to ComLucro. Today we are breaking down 30 of the most powerful trading psychology lessons from Market Wizards, written by Jack Schwager. If fear, greed, frustration, or hesitation have ever destroyed a good trading plan, you are not alone. Every trader has faced that moment. What separates elite traders from everyone else is not a secret strategy or magic indicator. It is mindset, discipline, and risk control. In this video, we will extract the core lessons shared by legendary traders who survived crashes, drawdowns, and uncertainty while building long-term consistency. Because most traders obsess over entries, but the real foundation of profitability is behavior. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now let us explore the first 10 lessons drawn from the experiences of the market wizards themselves. Lesson 1. Capital preservation comes first. This lesson appears repeatedly in the mindset of traders like Paul Tudor Jones and Ed Seykota. Before thinking about profits, they think about survival. They understand that trading is not about winning big on one trade, but about staying alive long enough for an edge to compound. Every decision starts with the same question. What happens if this trade fails? When capital is protected, opportunities always come back. When capital is damaged, options disappear. This is why professional traders think defensively first. They know that one uncontrolled loss can erase months or years of progress. Preservation is not fear. It is respect for the game. Once you accept that your primary job is to protect capital, your entire approach to risk, sizing, and patience changes. Lesson 2. Accept being wrong quickly. Traders such as Bruce Kovner and Michael Marcus built their careers by understanding a simple truth. Being wrong is normal. What separates professionals from amateurs is how fast they admit it. The market does not reward stubbornness or ego. When a trade is not working, professionals exit without hesitation or emotional attachment. They do not argue with price or wait for validation. They understand that small losses are a cost of doing business. Holding on to losing trades in the hope of being right later is one of the most expensive habits a trader can develop. Speed of acceptance is a form of discipline, and discipline is what keeps losses small and manageable. Lesson 3. Risk defines the trade, not the entry. For traders like Larry Hite, the trade begins with risk, not with a signal. Before entering, they already know how much they are willing to lose and where they're wrong. Entry is secondary. This mindset removes emotional pressure because the worst-case scenario is already accepted. When risk is defined clearly, execution becomes mechanical instead of emotional. Traders who focus only on entries often feel stress during trades because the outcome feels uncertain. Professionals reduce that uncertainty by controlling position size and risk exposure. This is why two traders can take the same setup and experience completely different emotional states. Risk clarity creates mental clarity. Lesson 4. Discipline beats intelligence. Richard Dennis proved that discipline matters more than brilliance. He showed that traders do not fail because systems stop working, but because people stop following them. Discipline is what keeps you executing during drawdowns, after losses, and when confidence drops. Intelligence can create good ideas, but discipline is what allows those ideas to survive real market pressure. Many traders know what they should do, but fail to do it consistently. The difference between knowing and doing is discipline. Without it, Even the best strategy becomes useless over time. Lesson 5. Confidence comes from risk control. For Stanley Druckenmiller, confidence does not come from predicting the market correctly. It comes from knowing that no single trade can seriously hurt him. When risk is controlled, hesitation disappears. Overthinking fades. Decisions become clear and calm. This type of confidence is not emotional or hopeful. It is structural. It is built into the process. Traders who rely on prediction for confidence feel strong only when they're winning. Traders who rely on risk control feel stable regardless of outcome. This is the kind of confidence that lasts through losing streaks and volatile markets. Lesson 6. Adapt or fail. Few traders represent this lesson better than George Soros. One of the strongest themes in Market Wizards is adaptability. Markets change constantly. Volatility expands and contracts. Trends appear and disappear. The traders who survive are not the ones who defend opinions, but the ones who adjust quickly when conditions shift. Professionals do not marry ideas. They test them against price. When the market proves them wrong, they adapt without hesitation. This flexibility protects capital and keeps them aligned with reality instead of ego. Rigidity feels safe, but in trading, it is dangerous. Adaptation is not weakness. It is survival intelligence. Lesson 7. Simplicity outperforms complexity. Many traders in the book, especially Ed Seykota, emphasize simplicity again and again. Simple systems are easier to execute under stress. They reduce hesitation, confusion, and emotional interference. Complexity may look impressive, but it often collapses in real time when decisions must be made quickly. Traders fail not because their ideas are too simple, but because they cannot execute them consistently. Simplicity creates clarity. Clarity creates consistency. And consistency is what allows an edge to express itself over hundreds of trades. Lesson 8. Emotional control is a skill, not a trait. One powerful insight from Market Wizards is that top traders are not emotionless. They feel fear, excitement, frustration, and doubt just like everyone else. The difference is that they do not let those emotions control their actions. Emotional control is trained through structure, preparation, and risk management. When risk is defined, emotions lose their power. When rules are clear, decisions become automatic. Traders who wait to feel confident before acting rarely execute well. Professionals act according to their plan, even when emotions are present. Control comes from behavior, not from feelings. Lesson 9. Consistency comes from process, not results. Across many interviews, traders explain that focusing on outcomes destroys consistency. Individual trades are random. What matters is repeating correct behavior. The best traders judge themselves by execution quality, not by profit or loss. When process is respected, results emerge naturally over time. This mindset removes emotional pressure from each trade. Wins do not inflate confidence. Losses do not destroy it. Each trade becomes one repetition inside a long series. This process-based thinking is what separates professionals from gamblers. Lesson 10. Humility keeps you alive. A common thread among market wizards is deep respect for the market. They understand that anything can happen at any time. This humility protects them from overconfidence, oversized positions, and ignored risk. Traders who believe they have figured out the market often stop managing risk properly. That is when damage occurs. Humility keeps traders open, alert, and cautious even after success. It reminds them that survival always comes before profit. In trading, arrogance is often followed by a painful lesson. Humility keeps you prepared for uncertainty instead of surprised by it. Now let us explore the next 10 lessons drawn from the experiences of the market wizards themselves. Lesson 11. Patience is an edge. Many market wizards explain that patience is not passive, it is strategic. Traders like Jesse Livermore and Ed Seykota understood that most of the time, the best action is waiting. Markets offer endless noise, but very few high-quality opportunities. Impatient traders force trades, overtrade, and slowly bleed capital. Professionals wait for alignment, clarity, and favorable risk. They accept boredom as part of the job. Patience protects traders from low-quality decisions and allows them to deploy capital only when the odds truly favor them. In trading, doing nothing is often the hardest but most profitable decision. Lesson 12. Position size controls emotion. A recurring theme in market wizards is that emotional instability is often a sizing problem, not a psychological flaw. Traders like Larry Hite emphasize that when position size is too large, fear and hesitation automatically appear. When size is appropriate, execution becomes calm and rational. Professionals adjust size so that no single trade can disturb their emotional balance. This allows them to think clearly and follow their plan. If a trade feels stressful, size is usually the issue. Correct sizing keeps emotions quiet and decision-making sharp. Lesson 13. Drawdowns are part of the game. Every successful trader in market wizards experienced drawdowns. What separates survivors from failures is how they respond to them. Professionals do not see drawdowns as personal failure. They see them as a statistical and psychological test. During drawdowns, they reduce risk, review execution, and protect capital. They do not try to win it back quickly. Traders who panic during drawdowns often abandon their edge at the worst possible moment. Acceptance and control during drawdowns is what allows long-term survival. Lesson 14. You must know yourself. Many market wizards stress that self-awareness is as important as market knowledge. Different traders succeed with different styles because they align their strategy with their personality. Some trade fast, others trade slow. Some focus on trends, others on mean reversion. Problems arise when traders copy strategies that do not fit who they are. Professionals design systems they can execute comfortably. They know their strengths, weaknesses, and emotional triggers. Knowing yourself reduces internal conflict and increases consistency. Lesson 15. The market owes you nothing. A powerful lesson repeated throughout market wizards is that the market does not care about your opinions, needs, or past performance. Traders like Paul Tudor Jones understood that entitlement is dangerous. Every trade is independent. Past wins do not guarantee future profits. The market can change at any moment. Professionals approach each trade with humility and neutrality. They take what the market offers and walk away when conditions are not favorable. This mindset keeps them flexible, objective, and emotionally balanced. Lesson 16. An edge is meaningless without execution. Many traders spend years searching for the perfect strategy, believing that once they find it, consistency will follow automatically. Market wizards reveal a very different reality. An edge only matters if it can be executed repeatedly, calmly, and without hesitation. A simple edge applied with discipline will almost always outperform a complex edge executed inconsistently. Professionals do not obsess over constantly improving strategies. Instead, they focus on executing the same rules correctly, trade after trade. Execution is what transforms theory into results. Without execution, even a statistically sound system becomes nothing more than an idea. In the end, markets reward behavior, not potential. Lesson 17. Losing streaks test belief, not skill. Every trader, without exception, goes through losing streaks. In market wizards, these periods are described not as technical failures, but as psychological tests. The system did not suddenly stop working. What is being tested is the trader's belief in their edge. Professionals understand that drawdowns are part of the probability distribution. They do not panic or abandon their method at the first sign of discomfort. Instead, they rely on data, experience, and discipline to stay consistent. Traders who constantly switch strategies during losing streaks often compound losses and destroy confidence. Stability during adversity is what allows probabilities to normalize over time. Lesson 18. Independence of thought is essential. Top traders think independently. They do not depend on opinions, news headlines, social media, or market consensus to make decisions. Market wizards repeatedly warn about the danger of following the crowd. When everyone agrees, risk is often already priced in. Professionals build their own frameworks, test their ideas, and trust their process. This independence allows them to act decisively when others hesitate, and to step aside when others chase emotionally. Clarity does not come from external validation. It comes from preparation, experience, and self-trust developed over time. Lesson 19. Preparation reduces stress. Stress in trading usually comes from uncertainty and improvisation. Market wizards show that preparation is the antidote. Professionals prepare scenarios before the market opens. They know in advance where they are interested in acting, where they will exit if they are wrong, and where they will stand aside. When price reaches those areas, decisions have already been made. This turns trading into execution rather than reaction. Traders who prepare thoroughly experience less emotional volatility during the session. Calmness is not created in the heat of the moment. It is built before the trade even exists. Lesson 20. Long-term thinking changes everything. One of the strongest themes across market wizards is long-term thinking. Professional traders do not judge themselves by a single trade, a single day, or even a single month. They think in series of hundreds of trades. This perspective removes emotional pressure and reduces impulsive behavior. Short-term thinking creates urgency, fear, and overreaction. Long-term thinking creates patience, discipline, and consistency. When traders truly adopt a long-term mindset, losses feel smaller, wins feel normal, and decisions become clearer. The moment trading stops being about today's result, performance begins to stabilize. Now we move into the final 10 lessons drawn from the real experiences of the market wizards themselves. Lesson 21. Discipline is built, not found. Market wizards make it clear that discipline is not a personality trait. It is a skill developed through repetition, structure, and consequences. Traders do not wake up disciplined. They become disciplined by following rules, even when it's uncomfortable. Discipline grows when traders respect stops, follow position sizing, and execute plans regardless of short-term emotions. Each correct action reinforces the habit. Each violation weakens it. Professionals understand that discipline is built trade by trade. Over time, this creates reliability, and reliability is what allows consistency to emerge under pressure. Lesson 22. Losses are information, not failure. Top traders treat losses as feedback, not judgment. In market wizards, losses are described as data points that reveal information about execution, conditions, or system behavior. Professionals analyze losses objectively. They ask what the market was doing, whether rules were followed, and if risk was respected. They do not attach their identity to outcomes. Traders who personalize losses often become defensive or emotional. Those who treat losses as information improve faster and stay mentally balanced. Growth in trading comes from learning, not from avoiding losses. Lesson 23. Overconfidence is as dangerous as fear. Many traders believe fear is the main psychological enemy. Market wizards show that overconfidence can be even more destructive. After winning streaks, traders often increase size, loosen rules, and take marginal setups. This is when damage occurs. Professionals remain cautious even after success. They do not confuse favorable conditions with personal brilliance. Humility keeps risk controlled and discipline intact. Confidence must be grounded in process, not in recent results. In trading, survival depends on staying balanced on both sides of emotion. Lesson 24. Environment shapes performance. Market wizards repeatedly highlight the importance of trading environment. This includes routines, schedules, preparation habits, and mental state. Professionals create conditions that support focus and clarity. They trade when they are mentally prepared, not when they feel pressured or distracted. Poor environments amplify emotional mistakes. Strong environments reduce them. Consistency is easier when distractions are minimized and routines are respected. Trading performance is not only about decisions on the chart, it's also about the structure surrounding those decisions. Lesson 25. You are not paid to trade, you are paid to manage risk. One of the most overlooked truths in market wizards is that traders are not rewarded for activity. They are rewarded for survival and risk management. Professionals understand that trading less can often mean earning more. They wait, filter opportunities, and protect capital aggressively. Risk management is not a defensive afterthought. It is the core of the profession. Traders who feel the need to always be in the market usually struggle long-term. The market pays patience, selectivity, and discipline, not frequency. Lesson 26. Stress is a signal, not an enemy. Market wizards show that stress is not something to eliminate, but something to interpret. When stress appears, it often signals misalignment between risk, preparation, and execution. Professionals do not ignore stress or try to trade through it. They investigate its source. Often, stress comes from oversized positions, unclear rules, or trading outside a plan. When those factors are corrected, stress naturally decreases. Used properly, stress becomes feedback that helps traders recalibrate before damage occurs. Lesson 27. Clarity comes from fewer decisions. Top traders reduce complexity, not because they lack skill, but because clarity improves execution. Market wizards reveal that decision fatigue is a real performance killer. The more choices a trader must make in real time, the higher the chance of emotional error. Professionals limit variables, standardize setups, and predefine responses. This frees mental energy and allows focus on execution. Fewer decisions create faster reactions, calmer behavior, and more consistent outcomes. Lesson 28. The market rewards consistency, not brilliance. Brilliant ideas mean little if they cannot be repeated. Market wizards emphasize that steady, repeatable execution outperforms occasional flashes of genius. Professionals aim for average excellence, not rare perfection. They accept small edges applied consistently rather than chasing extraordinary trades. This mindset removes pressure and reduces emotional swings. Over time, consistency compounds. Brilliance without control faints. Consistency without drama survives. Lesson 29. Responsibility ends excuses. A defining trait of market wizards is total responsibility. They do not blame markets, news, brokers, or other traders. Every outcome is owned. This mindset removes excuses and restores control. When traders accept responsibility, they regain the power to adjust, improve, and evolve. Blame keeps traders stuck. Responsibility moves them forward. Progress begins the moment excuses end. Lesson 30. Survival is the ultimate edge. The final and perhaps most important lesson across market wizards is survival. Everything else depends on it. Strategy, skill, psychology, and experience only matter if the trader remains in the game. Professionals prioritize longevity above all. They accept that markets will change, losses will occur, and uncertainty will never disappear. Survival allows adaptation. Adaptation allows growth, and growth allows long-term success. In trading, the traders who last are the ones who win. And with these lessons, we bring our Market Wizards series to a close. What you have seen here is not theory, motivation, or shortcuts. These are behavioral frameworks tested by traders who operated through losing streaks, uncertainty, and long periods where discipline mattered more than confidence. The pattern is consistent. Progress does not come from forcing trades or chasing results. It comes from patience, preparation, risk control, and disciplined execution. Across these 30 lessons, one truth becomes clear. The market is not conquered through prediction, intelligence, or constant activity. It is navigated through self-control, adaptability, and respect for risk. The traders who last are not the ones who trade the most or believe they are always right. They are the ones who survive long enough for their edge to compound over time. This focus on mindset and behavior also sits at the core of the work of Mark Douglas, author of Trading in the Zone and The Disciplined Trader. Here on the channel, we have a complete series breaking down 50 psychology lessons from his work, going deeper into how fear, discipline, and belief systems shape trading decisions and long-term consistency. To deepen this psychological foundation, I'm going to show a short clip from that series. It connects directly with the lessons you just saw and explains why consistency only becomes possible when mindset supports execution. Let us take a look. Lesson 1. Accept uncertainty. Traders lose because they crave control. They wait for the perfect setup, the perfect signal, the perfect moment. But the market does not owe you predictability. Trying to control outcomes leads to hesitation, emotional decisions, and unnecessary pressure. The most liberating shift is to embrace uncertainty and stop asking the market for guarantees. When you understand that you cannot control individual outcomes, you begin focusing on what truly matters. Uncertainty becomes part of the game instead of a threat, and your job becomes managing probabilities, not searching for perfection. Lesson 2. Think in probabilities. This is one of the most important ideas Douglas presents. Trading is not about being right. It's about thinking like a casino. A casino does not care about one hand of poker or one spin of the roulette wheel. It cares about the edge repeating over hundreds of trials. As a trader, your responsibility is the same. You are not trying to win every trade. You're trying to execute consistently so your edge plays out over time. Even a strategy with a 55% win rate can create wealth when executed with discipline. These ideas reinforce a critical point. No strategy works in isolation. When traders accept uncertainty and think in probabilities, execution becomes calmer, discipline holds under pressure, and consistency stops being accidental. Psychology is not a separate layer of trading. It is the foundation that allows every edge to function over time. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.